Hello and welcome to this episode on provisions relating to transparency and disclosures in the Companies Act 2013. We have with us today two eminent company secretaries to talk to us on this subject. To my left, immediate left is Narayan Shankar from the Mahindra Group, and next to him is Mr. R.R. Shastri, who's had a long career in the Tata Group, both renowned company secretaries. We're going to talk about in this episode about sections that deal with transparency and disclosures which have made a major impact as new provisions in the Act. So should I come straight to section 188 which deals with related party transactions, and this has been one of the major areas of reform that the industry is talking about. Can we start with discussing what is a related party transaction, who is a related party, and what section 188 does about it? So can I begin with you by asking, could you talk a bit about what is a related party and when does a transaction become a related party transaction?
Sure. Related party has been defined in the Companies Act 2013 in the definition section 2, subsection 76. And it lists out various people who will be considered as related to the company in a given transaction. So it talks about a director and all his relatives. It talks about key managerial personnel and his relatives. Then if a director is a director or a shareholder in a private limited company, that private limited company becomes a related party with the company. Then you have the relatives also of the directors and KMPs,
Right.
who are either directors or shareholders in other companies.
So when we say relatives, is the definition still as wide as the old law, or what's the
Currently in the Companies Act 2013, the relatives have been defined as members of a HUF. It includes the spouse, and the third category is left with the rules. And the rules today have come down from the current companies. The draft rules, which I'm telling, has cut short the number of relatives from about 21 to 15. But yet the relatives today also goes 2 generations above and up 2 generations below equally.
Right. So it could end up being a wide,
It could.
perhaps even wider than the old law, because
Wide,
the government has the right to prescribe.
Absolutely.
Right.
And just one more point I would like to add. Since Mr. Sastry was mentioning about relatives, the draft rules have further extended it to a director
Right.
or a key managerial personnel of your company, your subsidiary company, the holding company, or associate,
Okay.
and relatives of all these entities.
Okay.
So you
So
could
it's a
imagine
fairly large
large.
catchment area. So should we then come back to the related party transaction? What does the Act then say? What does Section 188 say about how related party transactions can be effected?
Today, if you see the Companies Act 2013, the key areas where directors become personally interested in the current Companies Act, it is 297 and 314 of the Companies Act, have been combined into 188. And it prescribes transactions which you can't do without the approval of the board, A, and transactions where you require to go to the shareholders by way of a special resolution. The key difference between 297-314 of the existing and the new 2013 is A, central government approval has been dispensed with. 2, when you are going for a special resolution for a particular transaction. And the key difference is if you have a transaction which is in the ordinary course of business and which is not an arm's length, then you will have to go, if it is in the ordinary course of business, you can go ahead, it's a carve out. But if it is not an arm's length, you would have to go and approach the shareholders resolution, where disinterested quorum is what is required.
Right. So would it be fair to summarize then to say that a transaction with a related party needs board approval?
Yes.
Is the board approval unanimous, or
board
approval
would be required,
and the shareholders
approval would be.
But this procedure would not be required if the transaction is in the ordinary course of business?
Correct.
and it's on arm's length.
It's an arm's length.
How exactly do we interpret the term arm's length transaction? What does the Act say about when does a transaction becomes an arm's length transaction?
Arm's length has also been defined in the Companies Act 2013. It's given by way of an explanation. And in a gist, what it says is that if the transaction is done with a party, irrespective of whether the party would be related to you or not, whether you knew the party or not, if it is based on the merits of the transaction, if it is based on competitive considerations, that would be treated as an arm's length transaction.
Right. So therefore, if the transaction can be demonstrably something that you would have otherwise anyway executed with any other party, even if you were not a related party, that would be the test of proving
Yes.
arm's length. But wouldn't all companies say that all their transactions are in any case on an arm's length basis?
Like he rightly pointed out, the expression arm's length has been defined to compare it with any transaction which, if they were unrelated, what would be really the situation. So it would be in the interest, and there is a huge onus on the board today to ensure that if a particular transaction is not an arm's length, then it has to go to the shareholders for a special resolution. So it would really facilitate, even if the institute comes out with a guidance note, specifically saying, because it also requires a practicing company secretary to again certify on these transactions. If you come out with checklists and broad guidance note, what would really arm's length really mean? Otherwise, you'll have to again refer to perhaps a transfer pricing, what is mentioned in the transfer pricing and other act, which may really not, which may perhaps be taking it slightly wider.
Right. In the corporate world so far, do you think companies would, out of abundant caution, take every related party transaction to shareholders, or they would take courage to say that this is at arm's length? What do you expect social reaction to be?
What I'd like to say is, first of all, if a transaction is to be done with a party who is considered as a related party, then the second question of whether it is at arm's length or not needs to be considered. So therefore, if a transaction is with a related party, then the company must ensure, and the board of the company should ensure, that the transaction is going to be done at an arm's length basis. While it will be a very, very conservative approach to go to the shareholders for everything, practically it is not possible. And therefore, the company will have to do a very objective assessment of every transaction, whether it can convincingly say that it is a transaction at arm's length, and therefore not need shareholders' approval. But the approach to go to shareholders frequently would not be in the interest of the company and not practical, as I said.
So this measure of transparency would actually push towards a substantive effect of the board having to consider every related party in great detail so that it can put pen to paper and sign saying it's in the ordinary course and on arm's length basis.
Absolutely.
Okay. Can we touch a bit about what happens if there is non-compliance with this requirement? Let's say a transaction which is not on arm's length gets executed without board approval or shareholder approval, or a transaction is outside the ordinary course gets so done. What does the Act say about the implication of such a contract?
The requirement today is that in case if you have entered into a contract, then the board or the shareholders, as the case may be, into which bucket it would fall, would have to gratify it within a period of 3 months. Here again, one carve out is, which we find both on a combination of the Act and the draft rules, is if it is pertaining to a related party which is a relative of a director, then actually the director concerned has to make good that particular transaction or indemnify the company towards that particular transaction. Here again, it would be very pertinent to note as we started off, if the list of relatives
Hmm.
cover a whole lot of 15 relations where the concerned director may not even have a control on, or may
Right.
not even know that they have entered into.
Right. So if there is a 3-month ratification procedure available, it would then mean that this process doesn't trump up reaction in a commercial emergency. Like you have a situation, you have to execute a transaction, it is a related party transaction, you can take courage, execute it, but get it ratified within 3 months. And if you can't get it ratified, you need to indemnify, but to indemnify you have to demonstrate a loss to
Absolutely.
begin with. The other implication is that it becomes voidable, isn't it?
Yes.
So how do you think that would work?
Well, I think that kind of a situation would come up if the transaction has been entered into by an executive of the company. For instance, one of the KMPs who's authorized to enter into transactions, if he has entered into a transaction which then comes to the notice of the board, and at that stage the board feels that this is a transaction which should have been pre-approved by the board, or it should have gone to the shareholders, then the board in that situation can avoid the contract. So
Right.
it is voidable at the instance of the board.
Right. But again, the board having signed the contract may not be attuned to using that right to make it void. Therefore, do you think this provision will have any other implication? Because I was thinking perhaps there could be a derivative suit. If a board, which in a shareholder's view ought to void a contract but is not, then the company is exposed to the risk of a derivative suit where a shareholder could seek a prayer to direct the board to void it and enforce an indemnity which
Yes.
is in the statute.
That consequence is possible, especially in a generation where you have informed shareholders,
Right.
and the shareholders are conclusively of the view that it was a transaction which ought to have been brought before them, but has not been brought before them. It would give them an opportunity to initiate action.
Right. So net it would nudge better conduct on the
Absolutely.
parts of boards of various companies.
Well, this again is arising from the tenets of good corporate governance,
Right.
and I think it is in that spirit that this provision has been incorporated in the
Right.
section. It will have to be followed in spirit and not only in letter. In spirit, one will have to see, unless one can very objectively justify a contract as something which is within the purview of the board or which needs to go to the shareholder,
Right.
I mean, there are bound to be difficulties which would come up.
Right. So it's a principle-based law, and as Narayan
Absolutely.
says, there's need for rules also or guidance
Absolutely.
on how to meet these principles. Before we part with related party transactions as a subject, can we also touch upon the disclosure requirement relating to related party? Like
In fact,
even
there is-
if it's on arm's length.
In fact, there is a very interesting provision which they have made saying that if there is a related party transaction being discussed at the board and a director is the concerned related party, he would have to step out of the meeting while the matter is being discussed.
Not just reference to
Abstain.
deliberation.
That's right. I mean, the Act wants that much of objectivity to be
Right.
attached to this particular
Right.
subject.
So even the unspoken participation
That's right.
is to be shunned.
Correct.
So there are two differences, therefore, that at the shareholders meeting, a fiduciary duty is brought in, that the shareholder who is the related party will not vote on the proposition, and at the board level, the director who is a related party will step out of the
Right.
deliberations altogether, not just sit and
Abstain.
observe others saying
That's right.
what they're saying. What about the disclosure of a related party transaction, even if subsection 1 doesn't apply, where it is on arm's length, it is in the ordinary course, but subsection 2 requires a disclosure. So could you talk a bit more about the disclosure requirement of such related party contracts? I think you have to give justifications of.
Yes.
So how would a justification work, if we can throw some light on that?
Well, the Act requires that transactions with related parties will have to be disclosed, and therefore, when it is disclosed, it will have to be accompanied by a justification as to why the company thought that this transaction, even if it was with a related party, was in the best interest of the company. So therefore, they would have to say that there must have been competitive bids, and after evaluating competitive bids, after evaluating the strength of the party, the domain knowledge of the party, the board has come to a conclusion that the transaction is in the best interest of the company.
Right. Or you could even justify saying it's in an area where there is no competitor
Right.
who could
Absolutely.
supply the same service. But you'll need to articulate and
Right.
justify.
But there would arise practical difficulties if related party is wide, and if none of the related party is allowed to vote. If specifically, at least the draft rules have to a certain extent address the issue of a wholly owned subsidiary, where they say that if you are a wholly owned subsidiary, there are only one shareholder, and if it is passed by at the holdco level, that's enough. That's the
Because you're in any case consolidating
it, the entire thing.
Right. So should we then move on from related party and go into another area of transparency and disclosure, which is section 134 and the disclosures to be made in the director's report. And I thought we could spend particularly some time on the director's responsibility statement, because this is something that now, as a matter of statute, casts a responsibility on board members and how they discharge that role. So can I invite you to speak on the DRS?
Today, DRS, which is covered under 217 and which is now covered under 134, the additional requirements which the DRS would now have to comply with is that in case of a listed company, they have laid down internal financial controls, and such internal financial controls are adequate and were operating effectively. Second, that the directors have devised proper systems to ensure compliance with applicable laws. So these two onus is on the directors and on the board as a whole, as well as disclosures would have to be made as part of a DRS, a director's responsibility statement, that this will really go to the shareholders, and they are actually confirming on these two issues.
Right.
So
and these are both pretty serious issues.
Pretty
right?
serious.
To say that we have enough systems in place to ensure compliance with all applicable law is basically saying we have done everything in our power to be able to say that we are compliant, or we have systems in place to ensure compliance.
In a way, it is stating the obvious. I mean, I think it has to be done by every company, having systems for internal control, systems for compliance with the laws and regulations. But by putting a director's responsibility statement, which is in black and white, I think it puts a greater onus on the board. And therefore, they would have to set up systems, institutionalize practices, and that would be in the interest of the board, the company, especially with the responsibility of independent directors going up significantly under the new act. I think this kind of a responsibility statement persuades the company to have formal processes rather than informal processes.
Right. Let's stay with that thought a little more. Will this lead to formality in process, or do you think it will lead to a substantive change? In that, let me ask the question differently, that let's say a non-compliance gets detected. Would that in your view mean that the directors made a false statement in the director's responsibility statement?
No, I would not think so. When you say you have set up a compliance mechanism, that is also supposed to detect instances of non-compliance,
Right.
and then remedial measures follow.
Right.
So if a non-compliance has been detected for whatever reason, intentionally or unintentionally, inadvertently, and if there is a remedy which is prescribed and that remedial action is taken, it still puts the company on a clean footing.
Right. It is not aimed at saying that you live in utopia
Absolutely.
and
No, not at all.
non-compliance will never take place.
It's impossible.
It's a statement to say that here are your systems and processes. If they work, this should lead to compliance.
Absolutely, and as he rightly pointed out, majority of the companies today have a robust system to ensure both in terms of internal financial controls and compliance of laws. Only by putting it in the director's responsibility statement, perhaps that may become more robust
Right.
Documentation may be much more.
Right.
And as he rightly pointed out, the onus is on devising proper systems by
Right.
the board,
Rather than
saying that there will be
you
zero
will be absolutely
non-compliance.
liable. So they have to put their hand up and say,
Yeah,
have we put in place systems which
in
will
place.
work towards compliance?
Compliance.
And if there lacks in that, then of course they would be violating the
provision.
requirement.
Besides this, the DRS and another important point which the board report will also have to make a mention is about the CSR. One, about the policy which they have devised and where the 2% spend is made. And if you have or read it jointly with 135,
Right.
which requires today the board to ensure spending of 2% of its profit, which is today profit before tax and not after tax, on CSR activities. A carve out in the proviso is that in case if a company is not able to meet the 2%, they have to justify why they were not able to do in the director's report. So this disclosure in the director's report would really be very important for all corporates, because there could be a chance that in case if you have not given this disclosure, the residual provisions of 450, which is equivalent to 629A of the Companies Act 1956,
Right.
would trigger, and corporates may
The consequences will
be
Can
open
we-
to consequences.
Right. Can we then move on to another area of disclosure? I'm referring to explanatory statements attached to resolutions which need to be passed. This is one area where governance also gets impacted. Do the entities or the persons who are required to give you an approval, be it the board, be it the shareholders, are they given enough information to give an informed consent to the resolutions before them? Is a question to be discussed. So can we talk a little bit about what the Companies Act 2013 does in this area of data or information being made available to assist an informed decision on resolutions?
Today, the directors have to comment on any adverse remarks made by the auditors and their justification. The board has to give explanations to the shareholders in the director's report.
Right.
Today, under the Companies Act 2013, this has also been extended to a practicing company secretary. A company secretary, that is in case of a secretarial audit, in case if there are adverse remarks, the board has to take note of that also, which I definitely feel is a welcome change. And it also would put huge onus on our profession, because the board is going to rely and actually going to comment on adverse remarks made by...
Yes, we have done an episode on secretarial standards and what it means for practicing company secretaries and members of the institute.
Yeah.
So I think this is a very welcome change.
Correct.
As well. So any other aspect of the director's report that we should talk about?
Second thing which I found is they have also, since we made a mention about compliance of all laws under DRS, today they have also to disclose matters coming under purview of risk management, that they have a robust risk management policy and they have developed and implemented that risk management policy in the company. So this is again a new disclosure to be made in the directors as part of the directors report.
Right, incremental reform therefore in company law. Should we move on to disclosures to be made to enable the forum which approves a resolution to take an informed decision? Let's specifically focus on the explanatory statement to shareholders when a resolution is taken to the shareholders. Could you give us an overview of what the position is in the Act, the 2013 Act?
Section 102, which corresponds to the old section 173, has in fact enlarged the scope of disclosures that should be made in an explanatory statement. By its very nature, explanatory statement is supposed to contain sufficient information and as much as possible to help the shareholders to take an informed decision on a resolution which is placed before them for their approval. Companies by and large make significant disclosures. They also mention about the interests of the directors of the company in a particular item which is placed before the shareholders. That has now been enlarged. I mean, it is not only the interest of the directors, the interest of the key managerial personnel and any other person whose likely to benefit by the shareholders approving that transaction, his interest needs to be disclosed. And I think it is a good practice, even irrespective of whether the company law provides for it or not, that on every transaction which is placed before the board or the shareholders, adequate information, relevant information must be given in the explanatory statement. This in a way mandates that, and I think it's a good thing.
Right.
While you have to give material facts to the shareholders, the key additions today is going to be in the subjectivity of language used in 102, specifically 102 subsection B, where shareholders are required to be told about meaning, scope, and implications of the items of business so that they are able to take an informed decisions.
Right.
So the explanation is not going to be just sort of a tick box exercise. It will have to be much more subjective.
In the context of meaning, scope, and
Meaning implications
for the shareholders,
to understand.
so that they then, being made known what
Correct.
the meaning, scope, and implications are,
Hmm.
then cast their vote.
Absolutely.
Right.
And
So what happens if an explanation is not adequate and the company suffers a loss?
if you see 102 subsection 4, which deals with both non-disclosure or insufficient disclosure, if you are caught either at one of these mischief, then the promoters are actually liable to make good the loss to the company, and they are liable to compensate the company. So the provisions on the promoters are huge and onerous. So they would be definitely be more careful in ensuring that all material facts, in fact more the disclosures the better, would be the mantra, I'm
Right.
sure.
So therefore, this would be again a case of not really testing the law on whether you pay compensation,
Correct.
but pushing those on whom this obligation has been placed
Correct.
to be that much extra cautious in how they disclose, so that they don't ever have to face a claim for compensation.
It will be similar to what companies do in a prospectus.
Right.
Like the more the disclosures, it's an insurance to the company and the
Right.
promoters.
And we do have an
Right.
episode on enforcement and punishments where
Hmm.
we talked about the implications and the penalties for misstatement in prospectus, returns, reports, etc. So before we conclude, may I request each of you to encapsulate in a minute or two anything that we've not covered and what your sense is of the Act 2013 in the context of disclosures and transparency. How do you view the Act on this one issue?
I'd like to speak about the disclosure of remuneration of employees, which is required to be done in the director's report. We had this under the old Act, the section 2172A, which required you to disclose information about the salaries, remuneration paid to employees over 5 lakhs of rupees, 5 lakhs or more. Now, that information will still have to be provided because they have not done away with that section, although there was a lot of talk that it might get dropped. They have retained those provisions. In addition to that, they have now said that the directors will also have to give the director's report the median remuneration of employees. And the way the median remuneration is to be computed is being illustrated in the rules which will be coming. It's a fairly complex method of computation, but it has to be done, and compare it with the remuneration that is paid to the directors and to the key managerial personnel. We do not know what exactly is sought to be achieved by this, but it is a kind of disclosure which the government feels is keeping in with the good corporate governance practices, to say that the managerial people are not drawing disproportionately higher remuneration and the other employees are being shortchanged. So that is another significant disclosure which is going to put out a very critical information in the public domain.
Okay. Is there anything else you'd
And
like to?
one point I would like to add is today in the director's report, you also have to make a mention about how your evaluation of the board is really functioning in terms of the evaluation of the board, committees, and individual directors. So it's not really board as a whole, and evaluation of individual directors being done by the other director. We have not been exposed, specifically closely held public companies, to a large extent. Even listed companies today are not all that exposed to such type of a scenario, and they will have to really start getting systems in place
Peer review.
of a peer review.
Right.
Directors over here in India, we are not really accustomed to having a peer review at all.
Right.
So they would have to have systems in place, a template in place, and also disclose how it's really working in the companies.
Right.
If I may add, apart from giving bare information or specific information which is required to be disclosed in all these reports, there will be a lot of need for good articulation in the reports.
Right.
And therefore company secretaries will have to pay a lot of attention to drafting things which will go into the report.
And develop the skill sets to be
That's
able to
right.
do that. So
Yes.
a fair degree of capacity building will be done by
Absolutely.
the institute as well.
While you have to
thanks
make
to this law.
Yes, you'll have to make truthful statements, and at the same time you have to make it in a manner that it is intelligible to the people who are reading it,
Right.
and conveys the right information.
In the Act is the use of the internet and the use of websites for various disclosures. Would you like to comment on that? What's the manner in which the acknowledgement of this platform of technology has been made in the Act for disclosures and transparency?
I personally feel that it is a very good step, and especially in a generation where the internet is so widely used. In fact, it will give a lot of relief to the companies also by putting a lot of information which is not in the nature of confidential information on the company's website. So although the rules and the Act in some places mention information should be put out on the website if there is any, I would encourage companies to setting up their websites and put a lot of information which will help the shareholders and other people, prospective investors, to get an insight into the company's operations, and also avoid the hassle of company dealing with requests from individuals to furnish information.
Right.
This is all the more important today of getting information on the website, because the provisions of insider trading today are equally applicable to unlisted public companies equally. So when you're talking of unlisted public company, what really could be unpublished price sensitive information? And specifically, if you're going to do a PE deal or a private equity coming into an unlisted public company, it's in their interest to ensure that material information is put up in the website, so that they are again not caught in the mischief of disclosing it unpublished price sensitive information on what I can say, not on a uniform basis, but on a pick and choose basis.
Right.
So if it is in the website, it will be uniform dissemination of information, and that will also help.
Right. But just to be clear, the Act does not mandatorily require you to have a
It's
website.
FNE.
If you have a website, you
Yeah,
ought to do disclosures
Yeah.
on that website as well.
Yes.
Okay. Thank you.
Thank you.